Today, we're going to tackle a question that seems simple, but the answer is anything but. Where does money actually come from? You might be thinking, a government printing press, right? Well, the real story is a lot closer to home, and honestly, it's going to change how you look at your own bank account forever. So let's get into it. Okay, so let me ask you straight up. When you imagine new money being made, what's the first thing that pops into your head? For most of us, it's probably some big government building with machines just printing stacks of fresh, crisp bills. But what if I told you that whole picture is basically a myth? The vast majority of money in our economy today isn't printed at all. Nope, it's created somewhere else entirely. The famous bank robber Willie Sutton had this classic line. When asked why he robbed banks, he said, because that's where the money is. It's a simple idea, right? Money is a physical thing. It's stacked up in vaults, so you go where it's stored. Well, here's the thing. From a modern point of view, Willie Sutton was completely wrong. Most of our money isn't cash sitting in a vault. It's just numbers, electronic ones and zeros on bank computers. And that one little fact, it changes everything. So this brings us to this massive misunderstanding about what banks really do. We tend to see them as just safe places to store our cash, like a glorified piggy bank. But their role is so much bigger, so much more active, and honestly, way more powerful than that. And here we are. This is the big idea, the one thing to take away from all this. Your local commercial bank doesn't just hold onto your money. They literally create new money. Poof! Out of thin air. Every single day. So forget the printing press. The real action, the place where most money is born, is inside the banking system itself. The question is, how on earth do they do that? Okay, let's break this down with a really simple story. We're going to follow a chunk of cash as it enters a bank and watch, step by step, how this financial magic trick actually works. It's a process called fractional reserve banking. So our story kicks off at a made-up bank. Let's call it Singleton Bank. Imagine someone walks in and deposits $10 million. On the bank's books, two things happen. Its assets, the cash it's now holding, go up by $10 million. And its liabilities, what it owes to the person who deposited it, also go up by $10 million. See? Perfectly balanced. All right, now here's the most important rule of the game. Banks are not allowed to lend out every single dollar they take in. They have to keep a certain percentage, a fraction, in the vault. Just in case people want to come and withdraw their cash. This rule is called the reserve requirement, and it's set by the central bank. So let's say that reserve requirement is 10%. That means Singleton Bank has to keep $1 million of that deposit on hand. But the other $9 million, that's fair game. They can lend that out. So they give a $9 million loan to some local business. Now, look at what the bank's assets look like. They've totally changed. Instead of $10 million in cash, they now have $1 million in cash reserves and a brand new asset, a $9 million loan that they expect to get paid back. Okay, stop. This right here, this is the magic moment. Just think about what just happened. The original depositor, they still have their $10 million. They can look at their bank statement and see it right there. But the business owner also has $9 million that they can now spend. By just issuing a loan, Singleton Bank expanded the amount of money in the economy from $10 million to $19 million. Just like that, brand new money was created. But, it doesn't stop there. Not even close. The business that got that $9 million loan, they're going to spend it, right? Maybe on new factory equipment. And the company that sold them the equipment, what do? They deposit that $9 million into their bank. And now the whole cycle is ready to start all over again. This incredible chain reaction actually has a name. It's called the money multiplier effect. That first deposit doesn't just create one loan. It sets off this whole cascade of new deposits and new loans that ripples through the entire banking system. So that second bank now has a fresh $9 million deposit. It keeps 10% in reserve, that's $900,000, and it loans out the rest, $8.1 million. And that $8.1 million gets spent and then deposited in a third bank, which then loans out a piece of that. The cycle just keeps going and going, with each new loan getting a little bit smaller, until that original deposit has been multiplied many, many times over. So how can you figure out the maximum impact of this whole chain reaction? Well, there's a surprisingly simple formula for it. The money multiplier is just 1 divided by the reserve requirement. So in our little story, the requirement was 10%, or 0.1. 1 divided by 0.1 is 10. That means our original $10 million deposit has the potential to create up to $100 million in the total money supply. It's pretty incredible when you think about it. Okay, so if all these regular commercial banks are the ones creating money, you've got to be asking, who's actually in charge here? Who's running the show? Well, that's where the central bank comes into play. Here in the US, that's the Federal Reserve, or as you probably know it, the Fed. Now, the Fed does a lot of things, but for our purposes, two of its jobs are absolutely critical. First, it handles monetary policy, which is really just a fancy way of saying it manages how much money and credit is flowing through the economy. And second, it tries to keep the whole financial system stable, to prevent it from all falling apart. So you can really think of the Fed as the puppet master of this entire system. By changing that reserve requirement, they can directly control how big that money multiplier is. If the Fed wants to cool down the economy, it can raise the requirement. Banks have to hold more cash, so they make fewer loans. If it wants to get things going, it lowers the requirement, letting banks lend out more and create more money. So we've seen how the sausage gets made, how money is actually created. But why do we have this system of fractional reserve banking in the first place? And what does it all mean for you and me? Well, this whole mechanism is both incredibly powerful and incredibly dangerous. It's really like a two-sided coin. On one side, this system is the engine of the modern economy. This money creation process is what makes it possible for businesses to get loans to grow, for families to buy a house, for you to get a car. It literally fuels economic growth. But on the other side, the whole system is built on a very fragile promise. The promise that we won't all ask for our money back at the same time. The fundamental risk here has a complicated name, but it's a simple idea. It's called an asset-liability time mismatch. Think about it. A bank's liabilities, that's your deposits, can be taken out instantly. You can go to the ATM right now. But its assets, all those loans made for houses and cars, are locked up. They get paid back slowly, over years, sometimes decades. If too many people demand their money all at once, the bank simply can't pay. And that's how you get a classic bank run. And this is not just some theory from a textbook. This exact vulnerability was at the very heart of the 2008 financial crisis. When the housing market crashed, tons of people couldn't pay their mortgages. All those loans, which were the bank's assets, suddenly became worthless. And it almost brought down the entire global financial system. And the consequences are just brutal. As our source material puts it, when banks get into trouble, they slam the brakes on lending. That sudden stop, that credit freeze, deals a crushing blow to the real economy. Businesses can't get loans, people stop building things, factories shut down, and millions of people lose their jobs. So that number in your bank account, it isn't just a number, it's a promise that exists inside this incredibly powerful, but also incredibly fragile system of credit that makes our whole world run. We saw in 2008 just how easily that promise can break. So the real question isn't just where money comes from, it's whether the system that creates it is strong enough to handle our future.